All right, so good evening once again. As I said, tonight we are starting the trade management series. Okay, it is part of the mentorship program that I'm having with the last batch of the mentorship class. But since most traders find it difficult understanding the actual technicalities behind risk management, I decided to share the first lesson of the trade management series with everyone. Okay, so that we get to know the ins and outs of it, how to manage our risk and stuff. All right. So without much ado, I'm going to be sharing my screen and I have some PDF that I'll be showing. Okay. I think most of us here have seen that PDF before. If you've not seen that PDF before, and today is your first time seeing that PDF, don't worry. It is actually risk management PDF that I compiled myself, and that is what we are going to be using. All right. So let me start by sharing the screen. Okay, so we are going to be talking about risk management. All right, as I said, it is the first section of the trade management series. Okay, so under risk management, we're going to be looking at what is risk management, why do we manage risk, how I personally do my risk management strategy, and like a whole lot of things tonight. Okay, so tonight's session is going to be very interactive. Okay, now there is this issue with we Ghanaians, I'll say Ghanaians, most importantly, those that normally come to my Zoom session. Please, if you don't understand anything, just let me know, okay? Just raise your hand or type your question into the chat space. I'll do my best to explain things to you, okay? Rather than you not asking questions and then thinking that, yeah, you've understood everything. By the end of the day, you've not understood anything at all, all right? So let's get started. Now, the first thing that I want us to be looking at is the content of this risk management material. So first of all, you see, because the business that we are in is a risky business, I need to let you understand the risk warning or the risk disclaimer attached to the business. Okay. Then we talk about risk management, we talk about risk planning, then we talk about trading risk to reward ratio, position sizing, how to manage your risk, how to increase our importance of risk management and stuff. Okay. Then I'll also be giving you guys my personal way that I do my risk management and things. All right. So I want to be sharp and to be quick. So let's get started. As I said, if you don't understand something, just raise your hand or type your question onto the page and I'll do my possible best to explain. All right. So let's get started. Now, the risk warning. Once again, I am not a financial advisor to be giving you financial advices or investment advices. Every information that you're going to be getting from tonight's lesson is strictly for educational purposes. Don't go and stand anywhere and hold me responsible if you end up having losses or incurring such marginal risk whilst you are actually using the information that you've had. Okay, I'm just trying to let you guys understand. So before deciding to participate in the Forex market, you should carefully consider your investment objectives, okay? The level of experience you have, and then your risk appetite. Most traders, when they start trading, jump onto jump onto the market without them not having any sort of investment or trading objectives, any experience, and also they don't apply proper risk management. They just jump on, they see that, oh, this thing is going up, let's buy, this thing is going down, let's sell. At the end of the day, they lose huge amount of money, and then they will start saying, Forex is scam, Forex is this, Forex is that. But that is not the situation. That is not the case. It is you, the trader, that failed to have the requisite knowledge before participating in the market. What I'm trying to say does not also mean you need to study without you not practicing anything. No, that is not the case. Okay, whilst you are studying, you also have to be practicing the thing. So the reason why I'm saying this is there is a considerable exposure to risk in any off-exchange foreign exchange transaction, including but limited to leverage, creditworthiness, limited regulatory protection, and market volatility that may substantially affect the price or liquidity of a currency or a currency pair. Okay. Moreover, the leveraged nature of forex trading means that any market movement will have equally proportional effects on your deposited funds. This may work for you as well as work against you. What this particular section is talking about is that because forex market is a leveraged product, because we are trading the CFD aspect of the financial market, if we decide not to use any leverage at all, that is, we're using 1:1, it means we need to have a huge amount of money before we can even open a single trade. Okay, but because our deposited funds are relatively small and the trade quantity out there is relatively huge, for us to see significant changes as in return or losses, we need to use leverage, because the leverage gives us the opportunity to be trading large quantity of orders with small deposits. And because of that, a single movement in the market have proportionally either positive or negative effect on your account, depending on the risk exposure that you're having on that particular account.
It was at the other end. I went to the other side. It came to the other side. I don't know.
Action, but tonight I'm teaching.
I'm trying to mute the class so that the noise does not disturb. Okay, now the possibility exists that you could sustain a total loss of your initial margin or initial margin funds and be required to deposit additional funds to sustain your position. What this means, or what this statement is also talking about, is that because of the leveraged nature of the forex business, if you decide not to manage your risk, or you decide just to expose your account just to the market, in the case of you having losses, in some cases, you will be required to make additional deposit to be able to sustain the opened positions that you have. If you fail to do that, you are going to get what we call margin call. Your position will get liquidated. And at the end of the day, you will start blaming me, or you start blaming the person who introduced you to the forex market. It is not the fault of that particular individual. It is the fault of you, the trader. It is not the fault of the market. It is the fault of you, the trader. Understand that. Know this and know peace. So, the last paragraph, if you fail to meet any margin requirements, your position may be liquidated and you'll be responsible for any resulting losses. So as I said, if you decide not to make the deposit to sustain the running trades that you have, you would end up losing the account, okay? Or your position will end up being liquidated. And at the end of the day, the losses that you are going to incur, you are going to take, or you have to take full responsibility of that particular losses.
Recording in progress.
Because we are all trading the leveraged product of this particular business. So it is so important we know the risk associated with the forex market before we even try participating in it. These are some of the things most so-called mentors fail to explain to their prospect, fail to explain to their mentees, they fail to explain to the new trader. They make it look like, yeah, once you enter this business, you're going to be making money overnight. But in actual sense, that is not the truth. You need to put in the work. The mentor is there to shorten your learning curve for you because he's going to be giving you the process that he or she have been using that have been benefiting him or her, so that you won't learn the gibberish or the chaffs out there, but you will stick to what the mentor is actually teaching or telling you. Now let's go to what other aspects of the risk warning. So there are also risks associated with utilizing an internet-based trading system, including but limited to the failure of hardware, software, and internet connection. If you are venturing into this Forex business and you don't have correct or good internet connection at where you stay, please, you can just be learning. But before you go live, make sure you are at an area where your internet connection is so good. Because a single glitch in your internet whilst placing a trade can cause you more harm than you ever imagine. Also, if the device that you are using to trade, be it laptop or phone, is not up to date with the current software upgrades, you would also find your system lagging or something. So please, you need to check all those things before you think of engaging the market. Now, your broker is not responsible for communication failures or delays when trading via the internet. Let me repeat, your broker is not responsible for communication failures or delays when trading via the internet. It is not the fault of your broker, it is the fault of your internet connection. Trading is a risky business, so if you are not willing to take the risk, please, you can just go in and be doing spot betting or something else. But if you've decided to undertake or partake this business, understand that there is going to be risk associated. So before taking part in it, since it's a risky business, understand the risk associated, because past performances cannot guarantee future outcomes, and therefore invest in what you can afford to lose. This statement normally scares individual traders, scares investors when they hear somebody saying, invest what you can afford to lose. Yes, that's the truth. Okay, you don't need to go and borrow money all in the name of you trying to trade that particular money and then earn interest. When you go to the bank for loan, there's an interest on it. There's a lot of pressure on that money that you've gone in for. If you try trading with that particular money, same thing, if you try using your school fees to trade, if you try using your rent, if you try using somebody's money that is not actually yours to trade, if care is not taken, you might end up losing that particular money. And the end product of it is not going to be something that you would take it lightly. Okay. So let's understand the risk aspect of the business, and then we know that at the end of the day, this or that is what we are in for. Risk management. So let's talk about risk management. Since you've gotten to know about the risk warning, let's talk about risk management. Okay. Now, Mr. Gary Cohn says something very interesting, that if you don't invest in risk management, it doesn't matter what business you are in, that particular business is a risky business. If you don't have any risk and safety measures out there, let's say you are actually into selling of, let's say, fuel. If you are actually operating a fuel pump station, okay, for example, let's say Goyo. Sorry guys, my internet just messed up a little. So you see the internet I'm talking about. So if your internet is not all that cool, you might end up not getting that better results that we are all looking for. All right. So let's proceed. So I was using Goyle as a case study over here. If Goyle decided not to put in safety precautions or safety measures at where their pump is, at the end of the day, should something happen, who do you think is going to incur those losses and pay those damages?
Recording in progress.
It is going to be Goyle. At the end of the day, it is Goyle that is going to be held accountable. And Goyle cannot blame anyone or any other business because they themselves failed to have measures in place to mitigate the risk of, let's say, fire outbreak or something. All right. So that's what the risk aspect that Mr. Gary Cohn was talking about. Now let's talk about risk management. Management refers to the process we traders put into place whilst trading to keep our loss under control and to keep and to protect our trading capital. In other words, risk management is the process you use to mitigate or protect your trading capital from the danger of losing all your account balance. So the ways by which we traders put together certain process or certain ideas, certain system, certain strategies in order to mitigate or protect our trading account is what we call it risk management. So as a trader, the most important thing that you need to do, or the most important knowledge you need to have, is the knowledge in risk management. Because trading is basically of three paths. We have the psychology aspect, we have the technicals and fundamentals and those strategy aspects, and then we have the risk management aspect. A solid risk management plus very good trading psychology plus better trading system gives trading success. So risk management can help prevent a trader from losing all their money in their account and should be applied by both beginners and that of what experienced traders. What keeps most traders in the game for longer period is risk management. So risk is basically defined by likelihood a loss will occur. Since we are in a business of this risky nature, we need to have certain system in place that would also help us in managing that particular risk. Okay, now, if you manage your risk, you have a defined statistical edge, hence higher chances of what? Consistency in the market. Remember, there is no holy grail in the Forex market, so therefore, risk management itself is just a criteria to control your risk exposure when trading. Okay, it is just a criteria to control your risk exposure when trading, because we traders can't have any control of over the market. We just have certain things that we as individual traders can do that will give the market the opportunity to limit the losses that it is supposed to inflict on our accounts. You can't control the direction of the market. You can't tell the market to do whatever that you want the market to do. But you can tell the market, okay, so today, this trade that I'm about to take, I'm willing to lose $10, and that is it. Whilst I lost $10, or whilst I lose $10, I'm off the market. It ends there. You are telling the market by putting in place certain measures that the moment you lose 10%, you are off the market. Why should we manage our risk? Risk management helps to cut down losses. If risk and loss can be managed well, traders can then open themselves up to making money in the market. Because if you can't manage your risk and your losses very well, You would make money but you end up losing it at the end of the day. It is very essential but overlooked aspect of successful trading. So if you are a trader, don't think that strategy alone is the most important thing. Don't think that where you are entering the market is the most important thing. Understand that the risk aspect of it also plays a very major role in this business. It plays a very major role in this business. Because if you don't manage your risk well, regardless of the amount of profit you've had, you can lose all those profits within 1 or 2 single bad trades. So ways at which we can manage our risk. First, you need to have risk planning. 3, trading risk to reward ratio. And then 4, position sizing. Position sizing. What is risk planning? What is risk planning? Before you think of entering a trade, you need to predefine your risk. You need to have in your mind the amount you are willing to lose on that particular trade. So let's dive deeper into what risk planning is all about. This is essential in your trading as it helps you to maintain the consistency with the risk when trading the market. Being consistent in the market is a very tedious and very hard work. Okay, so with that being said, you need to have that appetite for risk planning. You need to have that zeal to plan your risk before you even enter a trade, so that at the end of it all, you know that this trade that I took or that trade that I took, I actually risked this amount of money on it, or I risked that amount of money, and I'm willing to basically lose that particular amount of money, and I'm okay with it. I wouldn't have any sort of psychological breakdown if I lose that amount of money. So the smaller portion of successful traders made it through consistency, which resulted from what? Risk management and good psychology towards your approach in the market. I believe most of us here have heard this statement before, that 90% of new traders lose 90% of their trading capital in 90 days. That is true. For us not to be part of those individuals, for us not to be part of those people that tends to lose their money within 90 days of entering the market, we need to have what? Proper risk management and good psychology. So planning your risk may come in a variety of ways, but the most common one that I personally use is what? Willing, is the amount you are willing to risk per trade. This risk planning strategy tends to confuse some individuals. They tend to get it all twisted. At the end of it all, it is not something that we can't also have that kind of access to. If we really want to do the risk planning, we can do it no matter how small our account is. It doesn't matter. So the idea of the amount you are willing to risk per trade is of personal preference, and it also comes down or boils down to your risk tolerance and your risk appetite in general. We have individuals that have high risk tolerance. We have individuals that have less risk tolerance. We have individuals that have, they don't care losing 50% of their account because it's kind of fee, they have the money. If you are somebody like me, who is as broke as hell, literally, okay, literally, you wouldn't want to expose much of your account to the market. Okay, so one may ask, what is the right percentage that I am supposed to use when trading? Depending on your account size, the maximum that you should go for is 2% on any given trading idea. The maximum, as I said, depending on your account. If your account is relatively small, you tend to risk relatively high so that you can see significant returns. If your account is really big, you risk something small and you would also end up seeing relatively better returns at the end of the day. So if you are trading prop firm, normally risk between 0.25% to 0.5%. The maximum on your prop firm account is supposed to be 1%. Don't exceed 1% on prop firm. The main advantage is that you will be able to make more trades at any particular time. So determine your risk dollar amount. Okay, you need to determine, okay, my account size is $10,000. And within this $10,000, I am comfortable losing, let's say $100. I'm comfortable losing $50. If I lose $100 out of my $10,000, I don't have any issue with it. I can still have multiple trades. You get it? So let's assume in this case, your account size is $10,000 and your risk tolerance is what? Is 2%. Meaning you are willing to risk $200 per trade. Okay, that is your risk, your dollar risk amount. Okay, your risk dollar amount, the monetary value that you're supposed to lose if the trade go against you is supposed to be $200, and $200 is also 2% of what? Of $10,000. I hope you guys are following. If you are following, let me feel your presence in the comment section. Just type 1. If you are following whatever that we are doing tonight, just type 1 on the comment section so that I know that, yeah, indeed you are following and you are actually enjoying tonight's lesson. Just type 1 in the comment section. 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 Okay, we've gotten some nice responses. Good. It means you guys are actually following very, very well. All right. Nice responses. So now, by calculating your risk dollar amount, we can ascertain how much we are going to lose if the trade goes against us. Okay, having this predetermined help us when taking the trade, even if loss is bound to occur. Because we decided that, yeah, on this trade, I am willing to lose that percentage. I'm willing to lose this. I'm willing to lose that. Okay, we decided that at the end of the trade, should the trade go against me, I am willing to lose this amount of money. I'm willing to lose that amount of money. So once you decided on that particular amount, then you go on to the kind of lot size you are supposed to use. Okay, so let's complete the risk planning and then we'll go on to the trading risk reward and then we proceed with the other portion. Hey, they are complaining they can't join the call. Then let me send the link again. Oh, wow. Let me try sending the link again. Because I don't know. It's supposed to allow individuals to join though. So let me see. Few minutes. Let me just send the link again so that those who are finding it difficult to join can go ahead and join. All right. But it is the same link that we've been using all the time. It's the same link we've been using. So all right, so let's proceed. I've sent the link over to them again. So once again, risk planning helps you to control the mental part of trading because you already know in advance how much you are going to make if the trade goes in your favor or how much you are going to lose if the trade goes against you. I would love to focus on the later part, how much you are going to lose if the trade goes against you. This part is so important. That is why we are to have what a predefined risk dollar amount. That's the reason why. Because you need to understand that at the end of the day, this is the amount of money that I'm willing to lose. That is the amount of money that I'm willing to lose. So if the trade goes against me, I'm comfortable losing that amount of money. Okay. And once you are done calculating that particular thing, then we proceed. So let's see what is next. Trading risk to reward. Okay. Now you've already identified or predefined the amount you are willing to lose at the end of the day. So the amount you're willing to lose in this scenario or in this case or in this instance is what? $200. And $200 is absolutely 2% of your what? Of your $10,000 account. No matter what the market is going to do, no matter how much your stop loss may be in terms of pips, the main goal is that if the trade should go against you, you are willing and you are comfortable losing only and only what? $200, nothing more, nothing less. Okay. By the time that I'm done with the position size and aspect, you would then understand the kind of rubbish you've been doing in this business. You understand the reasons why you end up blowing your accounts over and over and over. You would end up understanding the reason why you would make some profits and then one bad trade will clear everything off. All right. So the next point that I want us to talk about is the risk reward ratio. Is a risk to reward ratio. Risk reward ratio. Risk reward ratio. Now, what is risk reward ratio? Trading risk reward ratio simply determines the potential loss versus the potential profit on any given trade. Okay, so you knowing the risk to reward ratio of that setup that you are taking gives you a fair idea of the potential loss against the potential what? Profit. Okay, now The risk over here, you see, it is actually risk reward ratio, right? Okay, so the risk over here is defined as the distance between your entry point and then your stop loss in terms of pips. It is your what? Your entry point, the distance between your entry point and that of what? Your stop loss in pips. Whilst the reward, I beg the PDF, they are not going to drop them. So see, that one they are beg the PDF, they are not going to drop them. Okay, I beg, wow. I beg, by the video, they will figure them. Okay. The reward is also defined as the price distance between your entry and then that of your take profit. Okay, so the distance between your entry and your stop loss and then that of your entry and then the take profit gives you the risk versus, the potential risk versus the potential gain. In other terms, the potential loss versus the potential profit. So for us to be able to calculate risk to reward, these following parameters is needed, and it is very, very important. We need to understand that for us to know the risk reward ratio, we need to know our entry points, point number one, our stop loss, point number two, and then that of our what? Our take profit, being the third point that we need to understand. Let us assume that you are trading EUSD, for example. Okay, all these calculations that you see over here is bogus. Let me give you the simplest way to do it. Let us assume that you are trading EUSD, okay, at a price of, let's say, 1.7200. That's the entry, 1.7200. Let me try writing on the screen so that we would actually get the whole thing. All right. I've been writing in the pad that I'm having over here, so I think I have to bring it onto the screen. All right. We have the entry, Excel, and then TP. All right. So the entry over here, as I said, is 1.7200. Your Excel, let's say, is 1.7240. We are selling, okay? We are selling. So let me bring in the my sell order. Most of you know I love using limit order. So it's a sell limit on EUSD. The take profit is 1.7000. Okay, 1.7 thousand. Now, look at what have been presented on your screen right now. Okay, I've given you the entry, the stop loss being 1.7240, and the take profit being 1.7000. Now, if we are to measure, for us to know the distance between the entry and then the stop loss, you subtract the entry from the stop loss. Since we are selling, the stop loss is going to have relatively huge volume or huge value, than that of the entry, because we are selling. Our stop loss is going to be above our entry. So automatically, they're going to have huge value than that of the entry. Okay, and the take profit is going to have less value than that of the entry, because we are selling, we expect price to go down. Okay, so looking at the screen right now, what do you think is going to be the distance between the entry and then the stop loss? Input your answer that you are going to get in the comment section. Do you think it's how many pips? Yes, your answer in the comment section, your answer in the chat area. How many pips do you think that between the entry and then the stop loss is going to be? How many pips? Okay, I'm getting responses. Okay, I'm getting responses. I love them. I'm getting responses. I'm getting responses. Good. So the distance between your R stop loss and then that of our entry is what? 40 pips. Okay, it's 40 pips. That is the distance between this entry and this stop loss. What is the distance between the entry and then that of the take profit? Yes, give me the figures. What is going to be the value, the distance between the take profit and that of the stop loss? Good, it is actually 200 pips. So here, for us to get our risk to reward ratio, being the distance, I'm sorry, being the what was the risk to reward again? It is a what? The ratio that determines the potential loss versus the potential what gain. Okay, good. Now, oh, so I mean, you guys have started even answering the question already. Okay, so the risk to reward over here is going to be what? 1 is to what? 1 is to 5. Meaning you are risking 40 pips in order to get 200 pips. Okay, 40 divided by, 200 divided by 40, or it's 40 divided by 200? No, it's 200 divided by 40. Either way, so Nipa 40 kwacha 200, they're going to get what? Each individual will get 5. So it means the risk to reward over here is what? It's 5.
5 if it reached the tip of it, which
Okay, it is 5. So you are risking 40 pips in order to get 200 pips. Okay, the initial amount that we decided to risk was how much? The initial amount when we were doing the risk planning was how much? Yes, anyone? This will tell me if you guys were following. The initial amount when we were talking about the risk planning, that particular trader that we were using as an example, allocated was how much? Don't forget his account size was $10,000, and so he was risking 2%, and that 2%, its monetary value is what, $200. So Godwin, that is the correct answer. The person is risking $200 in able to gain how much? So the risk over here is what? 2%, and that 2%, you know, the risk amount is 200. So let's assume with this trader, if the person is risking 40 pips in hope of gaining 200 pips, of which the risk to reward ratio is 1:5. All right, it's 1:5. If the trade goes in the favor of this trader who is risking 2% on this particular trade, at the end of the day, the person will be gaining how much? Yes, anyone? The person will be gaining how much? In percentage wise? 10%. In monetary wise, it's going to be how much? $1,000. because well, you can't hear me. Then I think you need to connect your mic. I don't know if you've connected your microphone. If not connected, connect it so that you can hear me. Forcing, or you also have to connect your mic so that you can hear me loud and clear. All right. So this person who risked $200 on this trade setup or this trade idea, making what 10% or $1,000 at the end of the day if the trade should go in his favor. That is, if the trade goes in his favor, 200 pips. But if the trade goes against him, 40 pips, he is willing to lose. He's willing to lose how much? $200. Okay, he's willing to lose $200. Any question with the calculation I just did over here before I bring back the PDF? Any question? Any question, guys? Question? There's no question, so we can proceed. Okay. If no question, then let's proceed. These are some of the things that most traders fail to put in place. They fail to put in place all these factors, all this planning. They just jump onto the trade because they've been given a signal. They just use any risk they want. Now, if you notice this whole thing that we've done, I've not made mention of lot size over here, right? So the real question over here right now is that, now, if I'm risking 40 pips, what lot size am I supposed to use? So that if this trade goes against me 40 pips, I'm losing only $200. But if it goes in my favor, 200 pips, I am actually willing to gain $1,000. Let's go back to the PDF and then we'll be back to our calculation area again. So, in order to determine the risk to reward ratio, you need to divide the potential, but that's what we did over there. Okay, so as an example, if you want to enter a long position on this, blah, 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 the same example that we did over there. All right. Now, for us to know the lot size that we are supposed to use, let me take you to a very good friend of mine. He's a very passionate friend of mine. I don't joke with him. He too don't joke with me because he knows that I did for him, he too did for me. We did for one body. Is that okay? Both of us did for each other. All right. And that is almighty position sizing. I don't enter any trade without consulting him. He's more or less like an oracle to me. It is the position sizing that is going to give me the required lot size to use. Since I've already gotten all these parameters in place, we are now going to check what lot size are we supposed to use so that if the trade goes against us 40 pips, we are losing 200. If it goes in our favor 200 pips, we are gaining what? 1,000. What lot size are we supposed to use so that if the trade goes against us 40 pips, we are losing only 2%. But if it goes in our favor 200 pips, we are gaining what? 1,000. That is what we are talking about. on the next stage. So position sizing answers another important question of how big a particular trade should be. So there are several ways in which you can determine how big the position should be. Okay, how big, or the big thing that I'm talking about is how huge your lot size is supposed to be, or how big your lot size is supposed to be. Okay, now we've already done two things. We've done our risk planning. We've predefined or predetermined the risk we are willing to take on that particular trade. We've gotten our entry, our stop loss, and then that of our take profit, giving us our risks to reward. Now, the next thing that we are supposed to take a look at is our what? Our position sizing. Okay, this particular aspect answers another important question on how big your trade should be. And there are several ways one can approach this or determine how big that particular thing could be. It is all dependent, or it all depends on the kind of trader you are, because traders have different personalities and we all trade differently. But the risk aspect of it is something that need not to be altered. So if you are risking 1%, just be consistent with your risk. If you're risking 0.5%, be consistent with it. If you're risking 0.25%, be consistent with it. Don't be risking 1% today, and then let's say tomorrow you'll be risking another percentage. Okay, but in all, if you are the type of trader that take multiple positions, you can have 1% on a single trade, and then you disperse the rest of the percentage on the rest of the asset that you are looking to trade. But if you are a trader that tends to take a single trade every day, be consistent with your risk. Okay. Now, you should be able to consider the following when calculating your position size. Okay. 1, your account size. It is very important to know the amount you have in your account before you think of the lot size you are going to use. Someone may be having $100 and the person is willing to take or use one standard lot size on that particular account. Somebody may be having $300 and the person is willing to use one standard lot size on that particular account. It is not wrong. Okay, it's not wrong to use one lot size on a $300 account. Maybe your stop loss is 5 pips, and when the trade goes against you, you're just losing just $50. But if you are like some individuals that have stop loss of 50, 60, 80 pips, and your account size is quote unquote $300, I beg, don't go there. Okay. The second thing is the amount you want to risk percentage-wise. So the risk dollar amount that we calculated initially, you need to know the percentage that the particular amount corresponds to, looking at your account size. Okay. And then your stop loss. So now, just over here, you've gotten to understand the reason why we spoke about the risk amount and about the stop loss also, because the stop loss plus your account size and then the amount you are willing to risk, that is going to determine the lot size you are supposed to use. It is not the other way around. It's not the lot size that is going to determine your account. It's not the lot size that is going to determine your stop loss. It's not the lot size that is going to determine your risk amount in percentage wise, but it is the account size, the amount you're willing to risk, and then the stop loss that determined your lot size you're supposed to have on that particular trade. Okay, so the basic formula for calculating this is position size equals to account size multiplied by the risk divided by the stop loss. You don't need to do this calculation. Don't worry, I will take you to a site where you can have, or you just input the figures and then that's all. But I want you to understand the whole idea behind it. Okay, so example, imagine having a fictional account size of $10,000. Okay, and we have a risk of a risk tolerance of what? Of 2% per trade. And based on our analysis, we figure that our stop loss is going to be what? 50 pips. If you consider this particular formula over here, the position size or the lot size that we are supposed to use is what? 4 mini lot sizes. That is 0.40. That is what? 0.40. Let's bring it to this calculation that we did earlier on. Now, our stop loss is how much? So our amount that we have in our account is what? 10,000, right? It's 10,000. Our risk is what? 2%, right? So the risk is 2. And then the stop loss is what? Is 40 pips. That's our stop loss. So we have our account size, our risk, and then the stop loss. With this, if we are to follow the formula that we had back then, we are going to get 5 mini lot sizes. That is 0.5 lot sizes. But as I said, you need not to worry yourself about these calculations. Okay. Now let me take you to a site where you can have the calculation as simple as that. Okay, as simple as that. Let me share a screen so that we can just use that website in calculating our risk. Okay. So this is, let's go to this place. So you go to myfxbook.com and then you go to FX calculators. Okay. You go to myfxbook.com, then you go to FX calculators. Then you select position size calculator. Okay, position size calculator. This calculator has been the one that I have been using all the time. Though I have a simplified version in an app form that I normally use, but sometimes I would love sticking into this. Now, over here, you're going to have the currency pair, the currency your account size is in, your account size, your risk ratio, and then the what? The stop loss. The trade size, let it be 1. Okay, so let's input our figures. The value was what? 10,000, right? And the risk was 2%. The stop loss is what? Is 40. Is that correct? If I inputted the figures correct, let me see your presence on the page. Just type 2. If you can see this screen and you can see the figures are just inputted, just type 2 into the question, the chat space, so that I can know that you guys are following and following very well. Type 2 into the chat space. If you can see the screen that I'm sharing and also the figures that I've inputted. We are about 25 individuals on the call, so at least most of us should respond to the simple task we've been given. Okay, it makes the class very, very lively. All right, so let me feel your presence in the comment section by just typing 2 over there if you can see the things that I've just inputted. Just type 2. Just type 2. Just type 2 if you can see the things that I am talking about. Just type 2. Just type 2 if you can see the thing that I just sent. Okay, let's proceed. We've gotten majority of we on the call. So now over here you can switch the risk ratio. I mean the risk value being the percentage wise with money. So if you switch it like this, you have to input the risk amount. Over there, the risk amount was what? $200. If you switch it back to risk, you just input the 2. So any way that you want it to be, you can just stick to it. Now, if I click on calculate, it's going to give me the amount I'm going to lose if the trade goes against me, and then the lot size I'm supposed to use. When we did the calculation, I said something that based on the formula that was given earlier on, this will give us 0.50 as our lot size, 0.50 as the lot size. So let's see if that is what it's going to give us. Good. You see, the amount that we are risking is what? $200. The lot size is what? 0.5. So if you are the kind of trader who does not necessarily calculate anything, but just input any lot size at all, now you've learned something that if your stop loss is 20, or sorry, if your stop loss is 40 and your account size is $200, you don't have to use stop loss lot size of 0.5. If you do that, then you end up losing everything if the trade goes against you. But since our account over here is 10,000, we can use 0.5 lot size with stop loss of what? 40 pips. Because even if the trade goes against us, since we are willing to lose 2% of the 10,000, we are comfortable losing $200. I hope the explanation is clear. It is just as simple as that. You get it? It's just as simple as that. So this will give you the exact parameters you're supposed to use. So now you have all your figures over here. You have your stop loss, you have your take profit, you have your entry. So the lot size that you're supposed to use was 0.5. You input 0.5, you input your parameter, since it's a sell limit, you input it, and then you allow the market to do whatever that it wants to do. If your trade gets triggered, then you start managing it. If the trade is in your favor, you start managing it. We're not going to be talking about the management of trade today. As I said, it is a series that I am having. So subsequently, we're going to be talking about the things before the week ends. All right. So this is how we calculate our risk, being it the risk dollar amount, the predetermined amount that we are willing to lose in that particular trade, the percentage wise that we know that, yeah, this is what we are actually losing, the risk reward giving us the potential loss against the potential reward, and then the position size, and that give us the actual money, actual lot size you're supposed to use in order for us to lose this amount over here, $200, if the trade is to go against us. It is just as simple as ABCD. It is just as simple as ABCD. Don't get it twisted. So if you are someone who is risking 1%, meaning over here your loss is going to be at $100 and your return is going to be at $500 if the trade goes in your favor. If you want to risk less, let's go back to our site and use the site to calculate different risk ratio or different risk, and then we see the lot sizes it is going to be getting us. So please, the trade size is just the number of positions one would want to open. This will divide the lots for you for the same reason. Gordon, I don't get the statement you are trying to make. Please, the trade size is just the number of positions one would want to open. This will divide the lot. No. No, hold on. I'm not trying. I don't know if how I am understanding what you said is what it meant. Then no. Okay. The trade sizing is the same as the lot size. So if you can use the voice to explain what you wanted to say, I'm very grateful so that we can proceed.
Okay. So where the trade size is?
Where? The trade size.
The trade size, yes, please.
Over here.
Assuming yes.
Okay.
Yeah, that column, yeah.
Okay.
Assuming you want to open 2 positions.
Uh-huh.
And you put 2 there.
Uh-huh.
When you do the
Okay,
calculation,
it will calculate
to
divide the lot size for you. Okay.
Exactly, yeah.
Oh, no problem. Okay. Yeah, if that's it. I thought you were saying different in that one day. Yeah, that's how it does it.
Yeah.
Okay, so let's say I would even have spoken about that one. Some individuals want to spread their risk. You see, we have traders that love to see plenty trades in their account. Okay, you want to see plenty trade. Let's say one single asset, though they are risking 2%, but they want to see plenty trade. If you want to open 5 trades on that single asset, you type 5 over here, then you click on what? Calculate. It will give you the number of lot size as opposed to what use for that 5 trades that you are opening.
Yeah, exactly.
Okay.
Yeah.
At the end of it, although you have 5 different trades running with same parameters, you are going to lose $200 if the trade goes against you. Nothing is going to change. Okay. Yeah, nothing is going to change. All right. Good. Any question? So, as I said, please, if you have questions, just raise your hand there. I will mute you so that you can use the mic and then you ask your question. Let's try playing around the risk aspect. Let's say you are someone who is trading platform account and you want, with same parameters, but you want to risk 0.25. We have to be 0.25 of this particular what? 40 pips. Okay, forcing. Please, your hand is up. Can you please just ask your question and then I continue? Forcing, please, can you unmute yourself and then ask your question? Forcing. All right, let's continue. If Forcing unmutes himself, we would actually take his question and then we will just continue. Now, if I click on calculate, let's look at what is going to happen over here. You see what happened? It has changed to what? 0.06 lot size. 0.06 what? Micro lot size. So if you're trading $10,000 prop firm account and you want to risk to 0.25% on a 40 pip Excel setup, this is the amount of lot size you're supposed to use. That is if you're opening just 1 trade. But if you're opening 2 trades, you have to use what? 0.03. 0.03 times 2 will give you 0.06. It's just as simple as that. Yes, Gideon. Yeah.
Good evening. Thank you for your lectures once again. We really appreciate it. My question is that with, let's say I risk the I've risked 2% of the things like the position size calculator. I've used everything, and then I'm running, say, 5 trades. The trades, I'm running 5 trades at the same time.
Okay.
With the same risk of the maybe or with the profit, just if I just 1,000, if I just open
I think
if I have
your network,
maybe 5%.
Your network is distorted. So if you can repeat what you said, I would be very, very grateful. Your network.
Hello, Mr. Jaman. Is it better?
Yes.
My network is really bad. But since I was trying to ask that. Hello.
Yeah, I'm listening.
Yes.
Yeah, I can hear you. So proceed.
I'm trying to ask that. Position size. I've considered my risk, and then my profit to be 1,000, makes 2%, and it chose my way 200 pips. I'll have $1,000.
Hey, this your network.
Now let's say I run 5.
The network is not open crowd.
I'll type it and put it on the platform.
Send voice notes to me on WhatsApp. I will just listen to the voice note, and then I'll just call out whatever that you said, so that the whole class will get what you are trying to say, and then I'll answer it. Okay.
Okay.
Yeah.
Okay. Thank you. Thank you.
You're welcome. All right. So let's proceed. Same way. You are risking 2%, but this time around, your stop loss is 15 pips. Your stop loss is no more 40 pips. It is rather 15 pips. And your take profit is also no more 200 pips. But let's say your take profit is, let's say, 75 pips, of which is also 1:5, right? You got 50 multiplied by 5 is what, 75, correct? Or are they lie? 50 multiplied by 5 is 75, right?
Hello, Mr. Juman. So my question is that
Okay.
if I've done my risk to reward ratios, and then I know that maybe if my stop loss is 40, my take profit is 200 pips, and if the goes my way, I'll be in profit of 1,000. Let's say I use my position size calculator to calculate it, and then I see if in case I run 5 positions, my lot size will be maybe 0.3 or 0.03. Does that mean that my profits will be affected, or even after all the 5 trades run, my profit will still remain at 1,000, or will the profit be more than 1,000 because I'm running 5 trades? If all goes my way and I have 200 pips as profit at the end of the day.
Okay. Now, Gideon, I've gotten your question. Though you are sending the recording to me on WhatsApp, but your mic was still on, but I've actually gotten whatever that you were saying, and I hope most of the individuals on the call also got whatever that you said.
Okay.
Yeah. So
then yes, thank you.
Yeah. So since you are using the position size calculator, for example, okay. So let's assume that. Let's go back to the 40 pips so that I will use that one to explain to Gideon. So when you click on this, you are going to have the 0.5. And you are saying if you are to open 5 trades, the lot size is going to be 0.01. So you're going to have 0.015 running at a time. Okay. The profit is going to be the same thing, same way as the losses. If you maintain the lot size and then the number of trades that you decided to open, that the system actually gave you. So you open 5 trades using 0.01 as the lot size for each. In all, it amounts to 0.05, which correspond to what? You losing $200 if the trade goes against you 40 pips, but then gaining $1,000 if the trade goes in your favor 200 pips. Gideon, it's clear.
Yeah, I think it's clear. So it doesn't.
It doesn't affect it. No.
You are running 5 trades. Or
yes.
Yes.
All that matter is all the 5 trades that are running amount
it's just
to the risk amount.
One.
Yes. So if you decide to go in for 10 trades at that particular time, you should understand that all those 10 trades that you are running should amount to what? To the 2% you are risking. So if I input 10 over here, look at what happened. We are going to get 0.05 over here. 0.05 multiplied by 10 will give you 0.5. 0.5 multiplied by 40 will give you $200. Okay, Ogidi?
Yeah, yes, Mr.
Okay, all right. So, as I was saying, let's assume that
yes, thank you.
our stop loss is 15 pips. We are risking 2%.
Yes, sir.
Yes, another question, right? Okay, shoot.
I top up to what he asked.
Okay.
Does it mean that all the trades, the value is the same, the value of pips to a dollar?
No.
Because the question is asking, it might not give $1,000 because the values are not the same.
It will give the $1,000 if he have one asset but multiple positions. I think that was the question he was asking. Okay,
so it's not like different.
Yes, I think that it's like, let's say one asset. I'm running multiple positions on one asset. Maybe USD.
Okay.
No, it's not multiple assets, no.
Okay.
Just one asset.
Okay, that one.
Because I was saying it in reference to the positioning size calculator.
Okay. But if you decide to use different assets, you're not going to get the same thing. Mind you, every asset, depending on the quote currency, have different pip value. So you're going to get an asset that is going to give you huge lot size because their pip value is less. You're going to get an asset that will give you less lot size because their pip value is huge. Okay, for example, let's say we are trading Euro GBP. Okay, we are trading Euro GBP. All right, let's say with same parameters, 40. The lot size over here is going to change to 0.44. Okay, but when it was Euro USD, it was 0.5. But since Euro GBP have huge pip value as compared to Euro USD, the lot size has to be reduced in order for us to get what? $200 if the trade goes against us. But if you are just trading one single asset and you want to spread the thing all over, you can just have multiple trades. But you should understand that all of them is amounting to that single percentage or that percentage that you are willing to lose if the trade should go against you. That is the most important thing that we need to understand. All right. Now let's go back to the Euro USD and then let's switch to different asset. Different stop loss. So let's say the stop loss is 15. So we are willing to risk 2%. And 2% is what? $200. If I click on calculate, you see the lot size is going to 1.33. So if the trade goes against you 15 pips, because you use one lot size, one standard lot size, that is 3 mini lot sizes, you are going to what? Lose 200 pips. $200, okay? So sometimes you see some traders having huge lot sizes, but their stop loss is very, very small and their accounts are relatively cool. For example, let's say if you're trading a 200,000 account and your stop loss is 15 pips, okay? And your risk is 1%, of which 1% equals what? $2,000. Your actual lot size is going to be 13.33. Okay, so question, what is the advantages of having multiple trade size? Oh, it is not advantageous. As I said, some individuals want to have multiple trades right at a time. And sometimes too, others don't know how to take partial profit, okay? So they will spread their positions and then be closing some of them as the trade is going. So let's say if this is the trade that we are taking AUSD with 15 pip stop loss, but we decided to have 5 different positions. We are going to our stop loss, the lot size is going to be limited from 13.33 to 2.67. Okay, so each trade is going to have 2.67 lots. So I'm going to have 5 trades, each of them containing 2.76 lot sizes. Let's say the trade decided to go in my favor, 30 pips, okay, of which the 30 pips equals to, let's say, 2R. Say I was risking 1% and the stop loss is what? It's 15%. 15 divided by 30 is 2, okay? So if the trade goes to your favor, 30 pips, you've made 2% of the trade, or of the amount that you risk on that particular trade. Now, I can close some of the trade that is running and then let the rest run. That is, if you don't know how to close partial profit, you can use this in a way of closing your partials. But those of us who know how to close partials, I would love to have one single trade, okay, and then be closing the partials as the trade keeps on going. Is that okay? Is this whole thing well understood? Is it well understood? Hmm? Is it well understood? Mam Chomati Asire. Okay, so since if all like you understand what we are saying, okay, so Samuel, your hands is up. Please ask your question.
Please, how do you do the partial stuff?
Okay, so the partial stuff, I'll talk about the partial stuff when we are talking about taking partial profit, and then like when we get to the actual trade management stuff, I'll talk about that one. So for tonight, let's stick to the risk and the calculations, all right? I don't want us to jump ahead. All right, any question? Okay, if there is no additional questions, then I would love we end tonight's lesson. Okay, we end tonight's lessons. It's 8:10, and then we continue God willing tomorrow. Okay, normally we have the lessons at 8:30, but these days the lighting system at where I am is not favorable. That is why I've shifted the time to 6:40. So tomorrow we might start at, let's say, 7. It will all be dependent on where traffic may let me be at the time that I might be returning from town. Okay, so if I'm able to get home by 5, we'll do it same time tomorrow. But if I don't go home by 5, we'll do it at 7. Okay, so I really appreciate your time that you actually use in joining us tonight. I really appreciate it. Okay, I cherish every single moment that you guys actually share with me, because at the end of the day, you see, time is money. Okay, you may have something important doing, but you decided to just come and then listen to whatever that I want to share with you. I'm very grateful. So now you've gotten this powerful weapon in your trading arsenal. Make sure you utilize it. Okay, know the amount you are risking, know the risk percentage, know your stop loss, and then use your account balance, your stop loss, and then the risk percentage to calculate the lot size. That will help you know the right lot size to use. Don't just be using any lot size at all. At the end of the day, you are responsible for every loss that you have on your trading account. These days, money is scarce. $1 is almost 12 cedis, 50 pesos. Losing $1 is quite a challenge. So imagine having $1,000 account and because of careless risk, you end up losing everything. You've lost almost 12,000 cities, 12,500 cities, and counted to Sikano 125 million. And counted to 125 million. And yet, Kakatwa, Menana, I balance your mayor or where the baby call. Okay, there's a man, Melusa's career as Adam, now you know more than any. So I'll plead with you guys to let us utilize this information that you've gotten and also be patient with the market. Okay, it is not all the time that you even have to trade. As I said, this series is going to be very interesting. It will get to a point, it will sound boring to those who are not willing to take this trading business very serious. If you are willing to take this trading business very serious, you will know and understand how fascinating this particular topic is. It is one of the most overlooked topic in this business, but one of the crucial aspects also. Okay, so please do well and utilize the position sizing, know the risk amount, and then let's take it from there. Okay, quick one. Let me stop recording and then say whatever that I wanted to say.